The report from Marcus and Millichap was really excellent, and it may have been one of my favorite pieces of research that I've read from them. It goes through, along with breakdowns for 46 of the top multifamily markets. They point to a similar set of national trends that we talked about in CoStar's report, although they kind of go into it in a little more depth even than the CoStar report did. It talks about the broader economic pressures, talks a little bit about the capital markets and things from the perspective of the apartment market, and really kind of gives a nice robust forecast for 2022. Just in brief, it mentions how higher wages could alleviate labor shortages and supply chain issues are expected to persist. Both of those really seem like ingredients for inflation.
Yeah.
And it's looking less likely that the Fed will be able to really solve the problem. They might, the Fed's actions could be maybe symbolic and they might lessen the effects. But I think it's overdetermined at this point that we're going to see some inflation. Really, the Marcus and Millichap's top line message on the apartment market itself is fairly similar to the forecasts from Yardi Matrix and CoStar. Multifamily is not going to have another banner year like 2021, but the fundamentals are projected to improve even further this year at a more typical pace. Demand is going to outpace supply, surpassing a record 400,000 units of construction to keep availability low across quality tiers. And some of those projects, and we've mentioned this before, some of the projects that are scheduled to complete in 2022 may end up being completed in 2023, depending on how the logistics chain is and supply and labor shortage and all that kind of mess, depending on how that resolves.
A lot of folks watching, the supply chain, when things, can really open up. And as we were talking about, once just this madness kind of subsides and we can really get back to normal, what the economy looks like at that point. Matt, can you get into a little bit on maybe on the migration to the suburbs versus people living downtown? There's been a lot of talk about the downtowns coming back. What's the take? What did John?
And this is exactly what you noted here. The migration to suburban areas is expected to continue as the pandemic wanes, and so I think our investors, they're kind of looking beyond these primary markets into secondary and tertiary markets as well. Things continue to more or less disperse, and as renters look for opportunities and their lifestyle changes, and as investors themselves look for higher yields. I think that on that side, on the investment side, this report expects to see a great deal of competition from assets. I've been reading some things about European investors looking to enter the American multifamily market. That's outside this report, but that's just to say that it's incredibly competitive. And this quote right here is really just sums it all up here. The search for yield amid an increasingly competitive bidding environment will compel investors to consider assets across a greater selection of markets. This corresponds with the demographic shift to secondary, tertiary cities. It's also benefiting apartment operations. So people are spreading out and they're finding these opportunities that aren't necessarily big cities. Now, people will come back. They say elsewhere in the report that they're going to come back a little bit to the urban core. It's not going to be neglected, but there is these broader demographic shifts that look like things were moving towards the suburbs, even apart from the pandemic.
It's fascinating. Well, vacancy and rent growth in 2022. Can you just take us through that real quick?
Yeah. So this is a good example of the story of different markets that we've kind of really noticed as the pandemic has progressed. Some markets, have been hit really hard and been on the upswing. We talked about markets like New York last week, that the recovery is firmly in progress there. Some markets have been steady throughout. You can see this, this is like Midwestern areas here. But others have been strong just the whole time. And it only seems to be getting better. And that's these areas like Phoenix.
San Francisco is definitely the outlier in terms of.
That is the lone out for sure. And I almost, I've heard that San Jose mentioned a little bit in the same breath, but it is, that area, San Francisco is not doing
really depressing. And just for the folks on listening, via podcast and don't have, not watching on YouTube, if you are watching on, you're listening on a podcast, subscribe to the YouTube channel so you can get the full video. But, also get us on podcast so you can just listen to this in the car. But, they've really broken this down to kind of 4 different kind of bubbles: recovery in progress, sustained momentum, strong demand through the pandemic, and leading recovery after the initial shock. And so, but also you can find this report on grayreport.com if you want to go take a look at it for yourself. So really fascinating, Matt. Appreciate you walking us through that.
Yeah.
Any other thoughts on the report?
Yeah, no, I just like this chart too, because it measures the vacancy change from 2020 to 2022, as well as the rent growth. And that's where they're really correlating all these strong markets that have high rent growth and really, and kind of growing vacancies versus the ones that are really doing poorly with less vacancies with greater vacancies and lower rent growth. So it's a really nice illustration that, again, you can just see these groups that were implicit in other sets of data. They're really made explicit in this map here. Now, The next page is
tell us about this list,
where they really kind of start to put it on the line here, and they list they kind of rank what they think the top performing markets are going to be this next year. Orlando is at number 1. Now, if you scroll back up really quickly,
so is this the reports? Because we were giving John Chang, who can put this report together, we were giving him a little bit of crap because I think Indy is at the bottom of the list, and a lot of that is because of the downtown urban core. It's on the list, but obviously, they really like the Sun Belt markets, especially Dallas and others.
I have some words about Indianapolis too in a second. And I think, but it is interesting. I think Orlando it's a leading recovery after an initial shock. So that's this kind of story of the market. And
think about if the virus subsides, what is everyone going to do?
Exactly.
They're going to travel. They're going to frickin' Disney World with their kids.
I am going to Disney World this spring break, and
bam.
I know it's going to be
crowded.
Have fun. Okay. But yes, so Orlando is doing great. I don't see Indianapolis. It's not at the bottom. It is firmly in the middle of the pack. And what I think is almost a little bit more interesting about this list is that Indianapolis is the first of any Midwestern city.
Yeah. So if you're going to the Midwest, you're looking for yield, because sure, you can go to Las Vegas, you can go to Fort Lauderdale, which is number 3, but you're going to be paying. I just heard someone was paying a 2.5% cap rate. If we're dealing with Fort Lauderdale, same thing with Phoenix, West Palm, Orlando, or Las Vegas. I'm not as familiar with the cap rates in Orlando. I assume that they're quite low, especially when someone reads this report. So if you're looking for yield, if you go to the first market where you're going to get some yield, some good returns, that is a steady, sustained growth, which where they put it in, it kind of is at the top of the list.
Yeah, and you can look at the story of it versus of stability, and it certainly seems a whole lot less risky than some of these ones that are actively recovering after slumping down. And there's that implication. Well, is this volatility going to remain afterwards?
Yeah, 100%.
Another place, and I want to skip ahead here. It talks a lot. It delves in detail into the economic things that economic trends that we talked about a little bit earlier. But on this page here, we see the migration patterns associated with the rent growth. It is this, and then the next page where we can really see the difference at a glance at how the migration patterns. A lot of people seem to be moving to places like Miami and Florida. In the Sun Belt, you can see these markets like Salt Lake City, Las Vegas, Phoenix, and then these Texas markets as well. There's a big group of people that are all moving to the Sun Belt, and that can be seen in the rent growth of those areas as well. Top markets for population growth is Austin and Las Vegas and Phoenix, and those are both very high on, those are the ones that people are expecting. Now, nationally, they expect rent growth to be 5.2%, a little bit on the low end, considering Yardi Matrix and Apartment List and CoStar. Their projections seem to be about the 7% range,
Yep.
maybe. But I think 5% is a really nice number, and it's worth remembering that it wasn't always 5%. It was very much closer to 2 or 3 historically. So it's still going to be a really good year
Yeah.
for that as
Yeah,
well.
it'll be interesting. And then also just curious, if we do see continued inflation more than what is predicted, how that affects rent growth. Now, obviously, there's some conversation of, is it wagging the dog, and is it really rent growth causing inflation or inflation causing rent growth? And there's a lot of other inputs, and I think there's probably a little bit of both. But certainly we see wages continue to rise. Input costs going up. The producer price index is up, which is they're making stuff for future goods. I think we're talking about that later also. It's can that lead to even further growth outside of that 5 to 7% range?
Yeah,
we'll see.
That's one of the things that I thought was a little bit interesting, is that there seems to be a whole lot of momentum that's represented in these charts. We were looking at places like Boise to kind of slope downward a little bit because they had such rapid rent growth during the pandemic. We thought maybe there's a peak, but it seems like these now Boise isn't represented specifically, but Idaho is in this map as a place where there's a lot of population growth that may continue their rent growth momentum. But other places that were extremely popular at the top of rent growth lists, like Salt Lake City, that continues to do really well, and they continue to expect it above 7% rent growth.
I think, there's some interesting opportunities in some of those Mountain West markets. Interesting point that John Chang made last night during dinner was, we were talking about Boise, and he said, his big issue with Boise is just the liquidity. It's too small of a market, and you may have an issue on your exit. And so it's really, and he doesn't really have a dog in the fight. It's just, obviously the rent growth and population growth metrics are hitting on all cylinders, but there's different levels, different types of risk in going through some of those smaller markets. I think that if you understand the markets, you can have adequate liquidity to mitigate that. But it's nothing compared to, obviously, like a big primary gateway market. But it was an interesting point that he made about liquidity in the Boise market, which is top of the lists.